Welcome back to Real Estate Economics Weekly Webinar Series for October 2010. This is part 2 of our Austin, Texas MSA webinar. This particular section will address understanding the cycles and will present some 5-year forecasts for this particular market area. This graph shows total non-farm payrolls in this area. As much as any place we've seen across the nation, the job growth has been excellent here over a very, very long time horizon. Many Western markets we look at, particularly those across California, have been stagnant for at least 10 years, with total non-farm payrolls being no higher than they were in year 2000. That's certainly not the case in the Austin Round Rock MSA. We've seen steady growth, tremendous growth here really in the 90s, a little bit of a flat spot with the recession and post 9/11 events in 2001, the dot-com and that sort of thing. Another big move up in 07 or 08, a little flat spot here, but on a compounded basis, this area is running over 3% on a 20-year basis. There's practically not an MSA in the nation that wouldn't be jealous of those numbers. Let's look at it on a 12-month basis. You can see just huge job gains on a relatively small base in the 90s. If you recall the previous page, the 1990 job totals were under 400,000. So during the 90s, we're adding 25, 30, almost 35,000 some years on a base that was 300,000 or 400,000. Absolutely tremendous. A little bit of backsliding in 01, 02, 03, but then the job ramp right back up into the 30,000 numbers for 06 and 07. We've seen the tail off in 09 and some slow years here in 2010, 2011. But over the forecast period, pretty much a return certainly towards the historical levels and really a back to normal trend on a 5-year basis. Again, something that's not typical amongst many Western markets, and certainly something we'd love to see here in California. Let's look at the civilian unemployment. Again, these rates are absolutely astounding. 3%, 4%, 2.3% in 1999. You've got to recognize that at 2% and even 3% labor is relatively scarce. The only way to keep up or to keep wages steady at those levels of unemployment is to have a lot of new people come in, which we've seen in the previous job charts. So we've got people coming in, we're adding some housing supply, we're able to sort of keep those numbers very, very friendly, 5%, 6% in the mid-2000s. Now we're up to 6.8% here in 2010. I'll make another comparison to California. We have 58 counties in California. Only 8 are under 10%. So we're more than jealous on the fabulous performance of the Austin job market. Again, if you're living it, there's obviously stress around the edges, and certain industries are growing, others are contracting. That's what happens in recessions. But overall, this market's responded quite well to the Great Recession of 2008 through 2010. Let's delve into some 5-year forecasts here. One of the things that's really going to come to play in this market, as we see in many markets nationally, is a very reduced level of building permits over the next few years. You can see permits topped out in this market on a total basis of over 25,000 back in 2006. That number's come way off to about 6,000 for 2010, and then we'll get a gradual ramp back up through the forecast period. This will ultimately help offset the relatively limited job losses that have taken place in this market. We have many concerns, frankly, about what we've done to the ability to produce homes. Nationally, we've lost a lot of very small builders, a lot of the local builders and the one-off types. They're gone. Even some of the smaller state-sized builders, regional builders have suffered or disappeared. We think that there is an ability to ramp back up when the time comes if capital is available, but we're bound to have a period of very slow ramp up in housing production once we return to economic growth. almost market to market in any of the Western markets, any of the more appealing areas. We like to look at the population growth. Sometimes this census stuff gets a little dry, so we'll go right to the meat here. If you look at the 45 to 54-year-old category, I like to show this numerically. In 2000, there was about 154,000 people in the 45 to 54 category. Look at the growth to 2010. It's up into the upper 240 range, above 245, and the 2015 estimate about 272,000. This is in a demographic that tends to bring money, tends to have accumulated equity. Many cases these people are moving from other states, looking for states with stable fiscal, financial backgrounds for their retirement and pre-retirement homes. If you take an appealing market area like Austin and have a reasonably low cost of living structure, that's where you can draw a lot of migration from mature households. That'll be just an excellent market segment for builders for the next 5 to 20 years. Let's look at mortgage rates. 30 years now. This is on a national basis and on a yearly basis. So if you think, well, I saw some lower rates once upon a time and such a time, it's because these are all annualized. I believe it's been in the past week or two that the 30-year fixed hit a national low, 4.37%, historical national low. On this chart, you can see in 2008 we were at 6%. By 2009, we were down to 5%. That was when the government began to intervene in the mortgage markets and drove rates down to try to help stimulate the housing market. You can see we've got a couple of low years in here, so there are excellent opportunities if you're refinancing. If you have stable job prospects and want to purchase, rates will be low for a few years, but that tends to grow in the out years. So higher rates, unless we can get income growth in excess of that rate growth, that will ultimately help keep a lid on prices and make the cost to own accelerate pretty rapidly over the end of the forecast period. Let's look at housing demand and supply. In this graph, the blue line is the supply of housing. In almost all markets, supply grows relatively slowly. It is always difficult, seemingly nationally, to buy land, to get the approvals you need, to assemble the elements of construction and get homes up and sold. This market tends to have better supply characteristics than most. It's been able to keep up with those huge job growth figures we saw a couple of slides back. The green line is the demand for housing. So that's a relationship that's very closely tied with jobs. So you can see when employment is robust, when the economy is really working, the demand for housing grows very quickly, much more quickly than supply. The only way that demand can outlet is typically through prices. So prices rise during periods of good economic demand, then a recession comes along, something comes along to change that dynamic for a few years, and the demand drops back below the supply line. This is a fairly well correlated line, one of the best we've seen in the Western markets. We've got a little lower demand at present. If you look out to the 2010-2011 period, the green demand for housing is somewhat under the supply, so the employment totals have shrunk a little bit. In essence, the employment base at present is a little too small for the housing supply, and that usually presents good buying opportunities and high levels of affordability. We can look at that another way. This is the overbuilt, underbuilt characteristics. Through the 90s, this market was tremendously underbuilt. Jobs were being added in great numbers, people were moving in, and with 3% annual compounded job growth, it wasn't easy to keep up with demand even in an area where the supply characteristics were good. Since the early 2000s, we've been pretty steady with much more minor oscillations than in this last recession and economic downturn. We've become a little bit overbuilt by 20, 30, 40,000 units. We see that shaking out by about 2014 and 2015. We'll recapture those jobs and be back much closer to equilibrium. Here's how it translates into values, into house prices. The blue is the historical, or the forecast for the forecast period, median home prices. So that's either historical numbers up to present or our forecast going forwards. The supportable median home price is shown in green. Now that's the relationship between household incomes in this particular market and national mortgage rates. Most times these correlate pretty well. It was only during subprime across the nation that the forecast price and the historical price got way out of sync with the supportable price, because people could get mortgages that were far larger than their incomes would support, and as it turns out, their ability to repay. This market doesn't really show that sort of subprime bubble that we see in many, many markets throughout the West, and it'll be to this market's eventual benefit that things didn't get too out of sync and really overheated during the last bubble. Now look to the forecast period. The median supportable price is well above the forecast price. Homes are very affordable in this market compared to household incomes and interest rates. Households can afford more home in this market than the median price would currently support. So houses are undervalued, significantly undervalued at this time. And that's not really being recognized and acted on because we've got slow job growth, bad consumer confidence. All you have to do is read the newspaper. But that will gradually reach to equilibrium by about 2014. Now, if you watch the downtrend in the 5-year forecast period for home prices, interest rates, our forecast is to go higher, particularly in the out years of this forecast. That will help keep a lid on prices and keep that median supportable home price from again running away on us in this particular market area. Here's the median shown graphically. We had big runs up in the 90s, which was an excellent period, even a flat spot without any backsliding during the recession of 2002 and 2003. Moved up quickly again. We've got a flat spot now, but overall sustained growth over more than 20 years and out to a 5-year forecast period. Let's look at the changes on an annual basis. High single digits in most years, flat spot in 2003 and 2004 and again in 2009, with a return or really an unwinding of the undervalued situation taking place from 2011 through 2015. That's the end of part 2 of this week's webinar on Austin Round Rock MSA. Please join us for the third part today.